And that era, I think, is closed. And I think we're transitioning to whatever comes next. And whatever comes next, I don't think will be simple, fast, or predictable, but it is going to be different. And countries that used to share are not going to share, or they'll share a lot more exclusively than they used to. And that puts a huge emphasis on the value of commodities, because it's not a given that countries will be able to get access to the commodities they used to. Like, think about the energy metals, the cobalts, the vanadiums, the coppers, the nickels, and the oil and the uranium. It's all sort of on the table right now in terms of countries rushing out to secure what they used to just be able to buy from whoever they wanted to. That era is over. The new era has begun. So that increases the value of commodities for everybody. Simultaneously, we just got through 12 years of undercapitalization of the commodities market. So we're running short on supply of pretty much everything. And that's another factor contributing to, increased value on a global scale. And so that does make me super bullish on the commodity sector right now.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. I am your host, Daryl Thomas, and today we have the pleasure of interviewing Jay Martin of the Jay Martin Show, who is also the CEO of Cambridge House International. Jay Martin has interviewed a lot of brilliant minds in the commodity sector, and he puts on every year the Vancouver Resource Investment Conference. So today we're going to talk to Jay about his perspective on commodities, the sector, how is he positioning himself, and how is he filtering through all of the guests and all of the knowledge that he receives as being a journalist and a show host. So before we get into the interview, please hit the like button and the subscribe button. Take a look at this statistic that over 91% of people that have viewed my content over the lifetime of my channel have not subscribed. So please do me a favor, hit the subscribe button. It only takes a second to do so that you can support the channel and I can continue growing. Now, without further ado, let's get to the interview. Jay Martin, how's it going today?
Really good. Good to see you.
That's good. That's good. It's kind of interesting being in the same space, but I've always watched you interview and engage with guests on your channel, and so it's good to have you on my channel for the first time.
I'm excited, Daryl. Yeah, thanks for having me.
So Jay, if you could tell the audience a little more about yourself, and I mean, you have the Jay Martin Show, Cambridge International, and such, and you do a lot of different things. And so, what should the audience know about you?
I'm an investor. I'm a retail investor looking for the smartest home for my cash, Daryl. That's what I do. And on the back of that, yeah, we've got a handful of pretty fun businesses. One being a podcast and a YouTube channel. And this was launched originally as a very self-serving endeavor. It was like, I want to get better information. I want to stress test my theses with investors who have been in the game longer than I have. I want to hear from the smartest money I have access to. I want to hear their best ideas and what they're paying attention to. And so the podcast and YouTube channel started with that mission. It still has that mission today. I have guests on twice per week, typically money managers who have been in the game a lot longer than I have, made more money and made more mistakes than I have. And I can stress test my theses. And so if I'm really excited about something, I can bring it to the show and say, hey, look, I'm looking at this sector, this idea. And my guest can say, I think you're right, but I also think you're 10 years too early, or I think you're way off and here's why, or I think you're bang on and I'm doing the same thing, et cetera. And so it helps prevent me from operating in an echo chamber within my own portfolio. So that's really beneficial. And so that's the YouTube channel, the podcast. It's called the Jay Martin Show, really original title. I also publish a twice weekly newsletter. So I have a premium letter that comes out on Friday for my paid subscribers, and a free newsletter that goes out on Sunday for anybody. And it's a community of about 40,000 investors there that, I talk about two things. I start with human nature, and I talk about the psychology of decision-making, which in my opinion is sort of the most important tool in every investor's tool belt, is understanding your own heuristics, biases, blind spots, what intuition is and how it can help you and how it can hurt you as an investor. That's the free letter every Sunday morning. And then on Friday, we get deeper into the subjects of money and power and how to leverage those to make money for ourselves. And that's on Substack. It's the J. Martin letter. And then I also, produce an annual conference under the brand of Cambridge House. The conference is called the Vancouver Resource Investment Conference. It's every year in Vancouver, British Columbia in January. And that's very focused on the commodity sector. We'll have about 350-ish junior mining companies in a trade show, about 120 keynote speakers, taking one of our 6 stages built around the perimeter of the trade show, and maybe 4,000 to 6,000 investors, depending on the market. You know how it is, right? In a bull market, people are banging down the door to get in there, and in a bear market, it's a bit thinner, but that keeps me busy.
Yeah, definitely. So you're based out of Canada, I believe, and Canada is very rich with resources. So what was your journey like in being introduced to commodities, and how did you, pretty much, come to the thesis of like, okay, commodities is where I should be?
Yeah, well, Vancouver, British Columbia is, to a degree, the center of the commodity exploration business. And so prior to, a mining organization that's extracting and producing a mineral, you got to find the stuff, right? And finding mineral deposits around the world, super high risk, very special business. And it is generally financed in Vancouver, British Columbia for a host of historic reasons. But that's sort of the center of mineral exploration finance. And so cutting my teeth as an investor in that neighborhood, in that zip code, just gave me a competitive advantage in that industry, right? Had I been born in the Silicon Valley, I'd probably have a competitive advantage in the tech space. But I'm from Vancouver, BC, and that's what that city is really well known for. It's a bit of a cowboy market for sure. Like it's a high risk speculators market. There's lots of sharks in the water. It's a treacherous area to be an investor. But cutting my teeth there was incredibly valuable. Why I love the commodities market, though, Daryl, is because if you try to process the world, the balance of power, geopolitical influence, why some nations are haves and some nations are have-nots, if you look at that through the lens of understanding the supply and demand of raw materials, it gives you a lot of insight and provides a lot of logic to why some countries are powerful and some countries aren't. And so I tend to enjoy understanding global events through the lens of, who holds the materials that the world wants, right? Some people want, some people have, things are bought and sold. The exchange of capital for raw materials is largely how power is distributed as well. And you'll see that throughout history, right? Whatever the key commodities were during that era, go back 600 years, it was, wars were fought over nutmeg, and countries that produced the right spices were very powerful. And obviously today we think about, war fought over oil, but there's always been a commodity at the center point, whether it's gold, silver, rubber, 150 years ago, the United States went to war over bananas, in the Caribbean, like the weirdest things. But looking at global events through the lens of the supply and demand of commodities that the world wants and needs, it's just an interesting way to interpret the world, and I enjoy it. It's a lot of fun, actually.
Yeah. So tell me, just how are you preparing yourself? I mean, like you talk about commodities a lot on your show. You have a lot of guests that come on the show. Sometimes those guests may give you information that may either complement each other or give you a confirmation of one another, or sometimes it may conflict. How do you filter through the information that you receive from all the guests that come onto your show?
Well, I think that the majority of debates that I see in financial media, whether that's like macroeconomics or the commodities sector specifically, whether you're talking about the equities market and just conversation around stocks, et cetera, most of the debate that I see, Daryl, is just two people with different time horizons arguing about stuff that doesn't matter to the other person, right? And so when we see conflicts over, like, is it a good time for copper? Is it a good time for gold? It's all relative to what your time horizon is, And so step one for me, therefore, is like reminding myself what kind of investor I am. Like, I'm not a trader. I'm not a short-term investor by any stretch. I'm a long-term value investor. And so, that's the first filter that I use, is when I'm looking at a piece of information or an idea that I'm bullish or bearish on, I try to layer on top of that my time horizon. It's like, because that protects you to a large degree, especially when you're in a position, and for example, right now, I'm sure we'll get into, where maybe we're allocating capital and all this, but there's a couple sectors right now that I'm being quite aggressive in, and it's because there's zero competition and they're very hated industries and sectors. And I may be building a position today that falls by 20% over the next 2-3 months. I don't know. But because my time horizon is 3 to 5 years, and I can remember that, the short-term volatility between, this quarter, next quarter, doesn't keep me up at night, because I revisit my thesis and it's like, well, I'm not betting on what's going to happen this quarter. I'm betting on what's going to happen within 3 to 5 years. And so does the 3-month volatility matter to me? It doesn't. And so that's step one, I think. And that should be step one for like most investors, is ask the question, what kind of investor are you? And then you can process a lot of information through that lens. And that helps.
All right. So you mentioned that currently you all are investing in two major commodities. So which commodities are you most bullish on right now? Obviously, we have the uranium story, we have the oil inventory story, we got the coal story, gold. Like, there's so many stories, and we honestly, when you look at these charts from the previous commodities bull market, like, you could see almost every company just went straight up from 2003 to 2008, before the global financial crisis. And so which ones are you kind of looking at right now, and that you're positioning yourself for?
Yeah, you're right. There's pretty sound arguments behind a lot of hard commodities right now. And so I would start just by framing maybe the way I think about it, Daryl. And there's two sort of major trends at play right now. One is, just call it deglobalization. My whole life's been an era of increased globalization, which is just to say we were sharing things, right? Countries that had the cash or the credit could buy whatever they wanted on the global marketplace. And that era, I think, is closed. And I think we're transitioning to whatever comes next. And whatever comes next, I don't think will be simple, fast, or predictable, but it is going to be different. And countries that used to share are not going to share, or they'll share a lot more exclusively than they used to. And that puts a huge emphasis on the value of commodities, because it's not a given that countries will be able to get access to the commodities they used to. Like, think about the energy metals, the cobalts, the vanadiums, the coppers, the nickels, and the oil and the uranium. It's all sort of on the table right now in terms of countries rushing out to secure what they used to just be able to buy from whoever they wanted to. That era is over. The new era has begun. So that increases the value of commodities for everybody. Simultaneously, we just got through 12 years of undercapitalization of the commodities market. So we're running short on supply of pretty much everything. And that's another factor contributing to, increased value on a global scale. And so that does make me super bullish on the commodity sector right now. And running through the list, we could touch on each briefly, and I could share, where I'm more or less exposed. But, the gold argument, it's for me, it's a very attractive industry right now because of how hated it is, specifically the gold equities, right? They're really decoupled from the gold price. I can walk into high quality mid-tier gold producers right now, like I said, with zero competition. I love that. As I mentioned in my newsletter, I'm not buying these companies because I expect them to pop this quarter or next quarter. I'm just buying them because they're ridiculously cheap. And, a mutual friend of ours, Rick Rule, he'll tell you till he's blue in the face that, he's made all of his money by investing when there's nobody else in the room, when there's no competition. And when the gold market, whatever market turns, it turns really fast, and investors rush in to buy, but they're buying the shares that Rick is selling, right? He's already built his position 12, 18 months prior. And, so learning from mentors like that, I try to practice what they preach and what I preach. And so I'm being very aggressive in the gold sector right now, because I don't have to go down to the very speculative exploration stocks to get great torque. I can buy management teams that have 2-3 wins in their back pocket. with great assets in good jurisdictions, sound balance sheets, and they're so cheap right now. And so I love the precious metal sector, gold and silver right now for that reason. Copper, I'm a bit less exposed, but simultaneously equally bullish. It doesn't really matter which direction we go from an energy standpoint moving forward or an infrastructure standpoint. The copper industry has just been massively undercapitalized. And, I would argue that the world's not actually short on copper, but we're definitely short on copper above the ground. And the process of extracting copper from the ground is a multi-decade endeavor and multi-billion-dollar endeavor. And so we may be rich in copper beneath the surface, but we don't have it where we need it. And to get it out, it's going to take ridiculous amounts of capital, and it's going to take the price of that metal going up quite a lot to finance that. And so I'm quite excited about the copper sector. I'm very specific with my jurisdictions right now for a lot of the reasons that we just discussed. I think that geopolitical tensions are going to continue to be the trend for this decade, and so should be considered.
Uranium.
Really
quick on the copper section. I was listening to Robert Friedland of Ivanhoe Mines, and they had gotten their copper mine up and running. But yeah, it took. I think they bought the land in like the 90s, and it took like 25 years to get this mine going. And so, some people think that when you invest in these commodities, or when the bull market takes off, or when the government says, oh, we're going to go green, we're going to go electric, that this stuff is readily available, and it's not. Hello everyone, sorry for the break in action, but I want to tell you about the link in my description below. This is to the New Orleans Investment Conference. This conference has been around for years and have brought many people out, such as Milton Friedman, Gerald Ford, Alan Greenspan, and Margaret Thatcher. This conference is put on by Brian Lundeen and his team. Brian is the CEO of Gold Newsletter. This year, they're going to have speakers such as Jim Rickards, George Gammon, Peter Schiff, Rick Rule, Danielle DiMartino Booth, Lynn Alden, and many others. Now, I encourage you to click the link in the description below. You can choose to attend the live event, which I will likely be at, as well as the event that is live streamed. You can support the channel by using my link below, so I encourage you to check that out. Now, let's get back to the interview.
It's not, it's funny. It's the biggest confusion in the renewable energy conversation, isn't it? That it's easy to sit here and say, we need to transition to clean renewable energy. Well, who's not for that? Like, that's a really easy thing to agree with. It's like, okay, yeah, no, sounds like a good idea. When you get into how, that's when things get really complex and misleading. But most of the conversations don't actually go that far. They just end at, we need to transition to clean renewable energy. How we do that is by the only way we get there and build the infrastructure and the battery storage technologies that would actually be required to transition the world to renewable power would create the biggest rush in mining activity that the world has ever seen. And so I think the world will keep moving towards discovery of more renewable energy, but I don't think the same voices who have been condemning the fossil fuel industry and saying, leave it in the ground and we need to transition to clean energy are going to therefore turn around and sanction that we should permit every mine we could possibly discover in order to get the minerals we're going to need to actually store solar, wind, et cetera, power, and make that a reality, a cost-efficient reality, which it needs to be. The world's never transitioned from, one technology to a more expensive technology. That never happens like that. From an energy standpoint, it never has, right? We transition when it makes financial sense, and it hasn't made financial sense yet. I think it will. We'll figure it out, but there's a lot of discovery and innovation that has to happen between now and then. And the first step to transitioning to renewables should not be canceling fossil fuels. It should be building renewables, right? Like, you should build the bridge before you burn the last one. So anyways, lot to share on that. But yeah, you're right. And Friedland's one of the few. There's not very many organizations in the world that could actually build a copper mine. So you're investing in early stage copper exploration. You have to be really thoughtful about what their exit strategy might be, should they even find the deposit they're trying to, because there's maybe a dozen groups in the world that could finance the build of a copper mine. Whereas if you're in the gold sector, you've got hundreds of exit options, right? Mergers, acquisitions, self-finance, mine builds, all this stuff doesn't exist in copper and nickel because of the duration and the capital intensive nature of it. And then, on the uranium front, I'm It's not my area of expertise, Daryl. However, I've got one very large bet in the uranium sector, so I'm not distributed so much. But I've got a very large position in a company that's now the largest landowner in the Athabasca Basin in Saskatchewan. However, it's super early stage and speculative. This company has just been very aggressive in the last 2 years, scooping up greenfield properties surrounding a lot of uranium-rich properties, and so that's kind of where I'm very consolidated in the uranium. But it's similar. It's undercapitalized. It's hard to imagine a world thinking 10 years down the road. Again, I don't know what's going to happen in the course of 6 months to a year. Will the industry get overbought? Probably. But over the course of 10 years, what's going to happen to the uranium price? I think it can only go one way. Either it goes up or we run out of power. I think that's kind of inevitable. So again, getting back to time horizon, it's like, is uranium a good bet today? Well, it depends. Do you need to sell it in 6 months? Then I don't know. But you want to be sitting at the table in 2029, 2030, and then reflecting your portfolio, then yes, I think uranium is a fantastic bet.
Yeah, definitely. So valuations. So like many of like the U.S. energy companies, so like even when looking at like fossil fuels or like the Chevrons, the Exxons and stuff, like I was just talking I have a group chat with a couple friends that I met from Rick's symposium. And we were talking about just how expensive these stocks are, to like retail investors. But there's like a lot of opportunity in the junior spaces, and also in the companies that are, Canada listed on the TSX or listed in other countries like Brazil and such. And so how do you factor in, the mega caps versus the small caps? How are you invested in those spaces?
Sure. So because I have conversations for a living, being a podcast host, a YouTube host, and a conference promoter, I put a lot of emphasis on investor sentiment and investor behavior, more so than I do on technicals, to be honest with you. I think the markets are driven largely by human nature. So that's what I pay attention to in terms of capital flows and determining what is loved or unloved in the industry. I tend to go pretty early stage with a decent chunk of my portfolio. I'm quite barbelled in my approach, Daryl. So I've got really boring, stagnant, safe asset classes on one side, and then hyper speculative on the other side. I don't really have much in the broad equities market, actually nothing in the broad equities market. But over on one side, it's like, frankly, it's real estate, gold, cash over here. And then over here, it's early stage companies and lots in the commodities business. So, there's not a lot of risk capital out there right now. So companies traded on the venture exchange are so thin on liquidity that any shareholders are pretty desperate for a bid right now. So when anybody, when you're investing in a company, it's always a good question to ask, if I'm buying, who's selling and why? Because when you're acquiring shares in a company, you're acquiring from somebody. That's the marketplace. Most investors don't ask, why am I having a disagreement with the seller? Because if you're looking at this company and saying, I think it's undervalued and the price is going to go up. Well, if you're buying shares, you're buying it from somebody who's saying, I think it's overvalued and the price is going to go down. So you should be able to ask, what do I know that this seller probably doesn't know, right? And in the case of most sort of broad equities stocks, I don't think that question is asked very frequently, and most investors just buy it because the price is going up and they have no better reason. When it gets down to the juniors, like you discussed there, right now there's a lot of motivation in the market to sell because investors who piled into some of these stocks in 2020, 2021, took the 20% drawdown, didn't want to sell, took the 40% drawdown, didn't want to sell. They didn't want to take the loss. Now they're 80% down. They'd prefer to hold, but now they're squeezed on liquidity. They're running out of money and need to liquidate something. You see this reflected in, pick your poison, the credit card delinquency rate, the auto loan delinquency rate, new credit card application rejection rate. People need cash right now. And when they need cash like that, they'll sell. They'll try to get liquidity at any price, even at 80% drawdown. And so That's the motive for a lot of the sellers in the arena that I'm playing in right now, the juniors, the venture listed companies, because liquidity is so thin, they're so beat up. But a lot of these positions were built 18, 24 months ago and prices were a lot better. And so, in terms of valuing a company based on investor sentiment, those are a couple things I think about when I'm making my decision.
Mm-hmm. Yeah, that's good. Because, like some of the companies that I see listed on the, New York Stock Exchange or the NASDAQ, many, retail investors probably can't afford as many. But then when you look outside of the US, you begin to see cheaper shares of a lot of companies. And so just wanted to get your perspective on that. So like moving forward, obviously there's like how you mentioned, some of these companies in the junior space are looking for capital. I had Rick on my show and he talked about he's cutting checks, and so there's a concern about recession and how this may impact many the capital of these companies as well as the share prices. So what's kind of your take on where we're headed with this? Are you more in the recession camp? Are you in the middle, soft landing camp, no landing? Which one would you say you're in? Hey everyone, sorry for the break in action, but I have to let you know that I am now an affiliate with Miles Franklin. Miles Franklin has been a bullion dealer for over 30 years, and they provide some of the highest quality service to their clients as well as fair pricing on bullion products. So purchasing bullion through Miles Franklin not only stores wealth for yourself, but you're also supporting this channel to continue to provide free educational material for retail investors and those who may not be aware of many financial concepts that I discuss on this channel. So you can get started by sending an email to info@milesfranklin.com or calling 952-929-7006. Be sure to let them know that Daryl Thomas or the Money Level Show sent you, and I will receive credit for your service. I thank you all for considering this. Now let's get back to the interview.
Okay, so I'm quite concerned. If we're going to talk about a couple different time horizons, let's start with near term, right? Like maybe 6 months to a year. I'm quite concerned, Daryl. And the reason that I'm quite concerned is because of some of the data points that we discussed earlier: credit card delinquencies, auto loan delinquencies hitting all-time highs, if not close, and new credit card application rejections hitting all-time highs. Simultaneously, student loan payments are about to kick back in. People are being squeezed right now. They're squeezed. And the problem with that is that look at the energy prices. Oil is climbing. Diesel is already at all-time highs for this time of year. Diesel's actually up 60% just since the summer in Europe. And if you look at the production growth of oil outside of OPEC over the last decade, it's really only come from unconventional US shale. That's now rolling over, and we're producing less each month than the month prior. And EIA report came out last week about October projections, and sure enough, it's fallen again since September. Now, most people probably don't read those reports, but I guarantee you the Saudis and the Russians do, and their extension on production cuts moving into the new year is no coincidence. They know the world is being squeezed by energy right now, and they're going to contribute to that. Russia also quietly announced a limit on the export of diesel, by the way, last week, adding to our already inability to produce enough diesel for the world. So what does this mean, right? It means there's some subjects in macro that are complex and some that are really simple. And the simple one is that when the price of energy goes up, the price of everything goes up. And it lags because you have to fuel the tankers, fuel the factories, and then get products on the shelf maybe 6 months later. But the price of energy is going up, and I don't see any way it's going to come down in the next 6 months. We've already drained the SPR as much as we really can. U.S. production is not going to pick up. It's, again, been undercapitalized. That's kind of the theme with commodities right now. And Russia's now weaponizing their energy. Simultaneously, they've announced they'll sell gas to China at 50% the cost they're selling to Europe this winter. So, cards are being played. When the price of energy goes up, the price of everything goes up. And consumers are already too squeezed. And that data is out there. We know people can't afford their lifestyles right now. They can't afford their monthly payments. right now. So what's going to happen when, I mean, I'm not talking about the discretionary spending, but the necessities go up, food and fuel. I'm very worried about this in the near term. And I say this honestly, Daryl, like I'm a perpetual optimist, man, and I'm long human ingenuity and progress long term. But in the near term, I think it can be really painful for some people if they get caught flat-footed. And so I'm saying this right now is because I'm concerned about people that are going to be caught flat-footed who are already squeezed, already being crunched in their monthly budget, and things are about to get a lot worse and a lot more expensive when it comes to necessities. So, take a hard look right now at your monthly P&L. And bankruptcy reports hit an all-time high in August in the U.S. bankruptcy filing. So, like, are we heading towards a recession? Like, you tell me, man. Like, I'd love to find a way that we're not. I'm trying really hard. I just don't see it, and so, what does that mean for companies that Rick's writing checks into? He's cutting checks right now. Rick's smart. Rick's cutting checks because he knows companies aren't getting checks from many people, right? If you're a venture listed company, you need to raise capital right now. That's a tough proposition. You're not going to get the terms you want, to say the least, because risk capital is very, very scarce. Those that have been in the game long enough and have been strategic enough to be sitting on cash in times like these, like Rick, they can go in and negotiate phenomenal deals for themselves. But, I'll have 350 junior mining companies at my conference in January. I'm advising all of them right now, like, pinch every single penny you can. You don't want to go to the market for money right now. It's not what you want to be doing. And so bide your time as best you can, or do very strategic financings. And so, I'm near term, I'm quite concerned, to say the least. When you step back, it's hard to frame the future of the United States empire in a positive light right now. And I don't mean that like to be a doom and gloom pundit. I feel like a lot of what I'm saying today is quite negative, but, just stepping back and observing history over the last 600 years, we've seen the rise and fall of kind of 5 empires, right? Portuguese, Spanish, Dutch, British, and now the American. That's a lot of empires squeezed into, that time period. So it should give us some sense of the lifespan of empires. And, empires come and go. They're still lovely places. Madrid's a lovely place. London's a lovely place, and so is Amsterdam. But those empires have come and gone. And I think we're probably in the twilight right now. And during those transition periods, things get a bit uncertain, a bit rough, a bit rocky. So I'm more cautious than usual, Daryl. That's not the rosy picture I'd love to paint, but it's the one that I'm concerned about and thinking a lot about.
Yeah. I appreciate you sharing that. I'm a realist, so I like to just give it to me straight, what I'm saying? But it's also like, and obviously like things can change, and things of that nature, but just thinking about, the position that we're in, obviously rates are high right now. Well, semi-high, not as high as it was previously. Fed's tightening, government's still printing, government's still accumulating a lot of debt, budget deficits, and then, we had the CEO of Bank of America, I think, came out today and said the Fed has defeated inflation, and so I was kind of like, I don't think the Fed can't print resources and they're not affecting supply at all, and so it kind of seems like we're in this position where it's going to take a long time for more supply to come on, so inflation is going to be sticky for a while.
Yeah, I agree, and it comes back to that simple principle: when the price of energy goes up, the price of everything goes up, and I don't see how the price of energy is going to come down anytime soon. Outside of, sure, a globally coordinated recession would decrease demand, but your audience can fact check me on this. The global decrease in energy demand during 2020 was only like 8%. Like, it was a single digit. We had full-blown economic shutdowns. People locked in their houses, and we saw an 8% decrease in energy consumption. So even in the case of some globally coordinated recession, how much is demand actually going to fall? It's energy, right? Discretionary items fall off a cliff for sure, but some things don't. And so, yeah, I don't see a world in the near term where the price of energy falls soon. And so what's the price of everything else going to do? You tell me they've beaten inflation? Okay.
Yeah.
Sure.
There's a lot of I mean, even the 8%, like obviously, people weren't, flying. I mean, but or traveling and work, people working from home. But I mean, there was a lot of energy consumption. If you're looking at, some people think that Google searching or working from home on your computer doesn't require energy, and it requires a lot. So if you have a lot more people using that energy, it makes sense. So you have a investment conference coming up in January. You mentioned there's a lot of companies that are going to be there, and so what kind of advice would you give like investors that are going to be there? Obviously, Rick has a really good video on like interrogating companies at conferences, and this one sounds like it's going to be a massive amount of companies you could choose from. And so how should retail investors be thinking about this as they come to the conference?
Can I shamelessly promote a product right now, Daryl? Can I do that? So this is a product we just created for new commodity investors, because at last year's conference, and we've seen a surge of new investors come into the space, which is lovely. But I've been asked more in the last 24 months than ever before from an investor, how do I get started in the commodity business as an investor? And obviously there's like 100 answers to that question, and they could all be right, depending on your situation. So in response to that, we created a 10-chapter video course called the Commodity University. And it's super fundamental. So literally the first chapter is, what is a commodity? And we get into, a bit of history of the commodities markets, covering a handful of select commodities over time. We get into supply and demand dynamics. We do deep dives into gold, silver, copper, uranium, and energy metals sort of as a bucket. And then how to build a portfolio. What are the investment vehicles available to you? What are the pros and cons of each? Identifying counterparty risk, where you're exposed, all of this stuff. And so watch that course to prepare. Will be, but honestly, it's a phenomenal resource. I'm really proud of it. We priced it quite low. It's at thecommodityuniversity.com for anybody who wants to just build a ground level understanding or just brush up on the fundamentals. But it's education, man. That's the theme, right? And so listen to Rick Rule, watch your show. Step one for every investor is real simple to me. It's determine how much time you have to invest in being an investor. And that'll tell you a lot about what kind of investor you should try to be. Because, probably like you, I know a lot of people that came out in maybe 2020 on the back of the swing trading, day trading, trend, and they were trying to beat the market, right? And some with like maybe an hour and a half a day. It's not enough. It's not enough to try to be a day trader. I have about 2 hours a day I can spend in my portfolio between, a couple of businesses, 3 kids, I'm an athlete. So I have certain amount of hours every day I can spend just on my portfolio, but I don't have more than that. 2 to 3 hours a day is kind of ideal actually for a long-term value investor, because I can spend a lot of time looking at macro trends, big picture trends, stress testing those with people who have been in the game longer than I have, like listening to Rick's content, reading his articles, etc. Find a collection of people like that. And what I would say to anybody who's looking for, a quote unquote guru, I don't want to use that, but just for lack of a better word, finding the Rick Rule they want to follow, right? The Daryl they want to follow, is find the individual who also entertains you. And I don't mean a stand-up comedian. I mean, you authentically enjoy their content. They speak or communicate in a way that resonates with you. The importance of that is that if you don't enjoy the process of studying and learning, you're not going to go back every day, right? And you need to go back every day, because the only way you get better at this and develop your own competitive advantage is by compounding the returns of studying, right? And spending time in the market. But you have to invest over time. It's not like, you don't hit the gym today and get jacked tomorrow. You don't, hit the markets today and retire tomorrow. It is something that has to become part of your lifestyle if you want to take it seriously, and get serious about it. So step one, determine how much time you have to invest in being an investor. If it's half an hour a day just to read, one article, that's amazing. That's a great start. It puts you miles ahead of most, to be honest with you. And then so find those content creators that resonate with you, and start building your knowledge base from there. But find the resources and stick with them. Absolutely.
Yeah, definitely. That's good tips. Because I had took about a, I don't know, 5-month break from the channel and stuff, and I wasn't like, I was watching interviews all the time, reading articles, like everything. And so during that break, I was kind of like, okay, where are we at now? And it's like, it has to become part of the lifestyle. You have to continuously educate yourself and such. And so, otherwise, like, I mean, these things change quick. You may have your long-term thesis of like, okay, I think commodities are going higher, but, on my channel, I focused a lot on macro. Now I'm getting more into the micro dynamics of investing, but macro always changes. Like policies change, behaviors change. I mean, we had information about the BRICS coming out, and everything, and so like there was always something that was shifting, and so it took me a little while to catch up. When I took that time off, but it got to be part of your lifestyle. You definitely have to keep reading and keep educating yourself. So that's a good resource. It's called the Commodity Investor. Say that again. The website.
TheCommodityUniversity.com.
TheCommodityUniversity.com. We will leave that in the description below. Where else can people find you? I'm going to tag your YouTube channel. Where else can people find more information?
Appreciate that, man. Yeah, it's the Jay Martin Show on YouTube or wherever you listen to your podcasts, and it's the Jay Martin Letter on Substack to get my weekly distribution. So, and then the conference is CambridgeHouse.com. So there's a handful of things I'll point you to. I should consolidate this as I'm walking through it, but CambridgeHouse.com, that's my conference company. That's where you'll find all the information about the Vancouver event. Well, where I'll see you, Daryl, and Rick, and a handful of others. It's always so fun. And then Substack, YouTube, podcasts, and etc. Yeah.
And the conference is free, right?
It's free for investors. That's right. Yeah. There's a handful of tiers. There's VIP tickets if you want behind the scenes, meet and greets with the speakers, keynote dinners, all that stuff. Special seats, I think. But yes, it's general admission is free for retail investors. Yeah.
All right. So for the cheapskates out there, we got we got a free conference here. I've been telling you all about, different conferences over time. So if you want to come, be sure to come check out the Vancouver Resource Investment Conference, so you can meet me in person if we haven't met, and then also connect with Jay and many other people that will be there. Well, Jay, thank you for coming on today, and appreciate your time and everything, and just everything that you share with the audience today.
I appreciate you, man. Thanks. Thank you.